Short exercise 2-5, we're going to record transactions in the journal. So Arkansas sales consultants completed the following transactions during the latter part of January. So here are our transactions. Journalize the transactions of Arkansas sales consultants. Include an explanation with each journal entry. And as we always do in the journal, record debits first and then credits. And then select the explanation on the last line of the journal entry table. So let's take a look at this first transaction. Perform services for customers on account for $9,000. All right, for us to do the journal entries, we need to know our accounting grid. So in this screenshot, here's our accounting grid, which shows the accounting equation, assets equals liabilities plus owner's equity. And what are the four things that affect equity? Well, revenue increases equity, which is why I've placed revenue on the positive side of capital. And investments, also known as owner contributions, also increase capital. And then the two things that decrease capital are expenses and withdrawals. So I've placed them on the negative side of capital just to remind you that these two types of accounts make capital go down. So now that we have this, we can journalize the transaction. So this first transaction, we perform services for customers on account. So the key phrase is on account. So the customers are not paying us now. They are going to pay us later. So do we record cash? No, we're going to receive the cash later. So what do we get instead of cash? We're going to receive accounts receivable. So then we have to take a look at our accounting grid, and we have to know what type of an account is accounts receivable. So as you know, accounts receivable is an asset because it's a future value. So in this case, are our accounts receivable going up? Do we have more accounts receivable or do we have less? We have more. So since this is the plus side, that means our accounts receivable is going to be the debit account. So AR is going up for $9,000. And then we have to figure out, well, what's the credit account going to be? The credit account, well, why do we receive these accounts receivable? Because we made a sale. We performed services. So of these accounts, which one of these accounts is the one where we're recording a sale? It's revenue. Revenue represents a sale of either a service, which is the case in this problem, or a product. So do we have more revenue when we make this sale or do we have less? We obviously have more. Therefore, that is why revenue is going to be a credit because it increases on the credit side. So service revenue is increasing by $9,000. And then we need to choose an explanation. We perform services for customers on account. Next transaction, we received cash on account from customers. So the key part in this is receiving cash. So since cash is the easiest to analyze, let's do cash first. Obviously, cash is an asset. So we have to figure out, is cash going up or is cash going down? Well, we received cash, so cash is going up. Therefore, cash is the debit account for $7,000. Now, why did we receive this cash? Well, we received cash on account from customers. So this means customers are paying some or all of their accounts receivable. So remember, accounts receivable is an asset. So do we have more accounts receivable when customers pay off their receivables? Or do we have less? Well, we have less. So that's why AR, accounts receivable, is going to be credited $7,000. So AR is decreasing. So when you are analyzing these accounts, you always have to figure out, well, what type of accounts are affected, and are they going up or down? And notice not all accounts go up on the left. Some, like liabilities, go down on the left. So then we have to choose our explanation, which is we received cash on account from customers. Now, in the real world, we could just read this, read the debit and credit and know that we are receiving cash on account from customers. So in the real world, you would probably want a more helpful explanation like Joe Schmo paid off their account. So we do need to know who paid us our AR, or who paid off the AR. So January 31st, we received a utility bill, which will be paid in February. So remember, this is January. So we receive a bill, but we're not going to pay it till next month. So let's start with, do we owe more money now? Do we have more liabilities or less liabilities? Well, we have more liabilities because we're going to pay this bill the next month. So notice this liability increases on the credit side. So we have to list debits first. So we're going to skip the debit because the debit will be here. So we're going to increase the liability. So let's open up our chart of accounts, which is this little drop down, and let's see what type of payables we have. Accounts payable. Let's see if there's something more specific than accounts payable. We have utilities payable. So that's more specific than accounts payable. So I'm going to increase accounts payable with a credit for 210. So copy and paste. And again, we are going to credit this payable because liabilities, which is what payables are, increase on the credit side. And of course, if we receive a bill, we're not going to pay it. We have more debt. Now, so we have to figure out what the other account is. Well, we received a utility bill, and so we have to record an expense. And so do we have more expenses or less expenses? Well, we have more expenses, so that's going to be the debit. So let's open up our chart of accounts and see what type of expenses we have. We've got salaries expense. No, that's not good. Here you go. Utility expense for $210. So our explanation is going to be received a utility bill due in February. Now, if we got the bill and paid it right away, we wouldn't worry with the pay. We wouldn't have to deal with the payable. We would just lower cash with the credit. All right. So now, Arkansas sales consultants paid monthly salary to the salespeople for $2,400. And let's see if there's any extra information in here. Paid monthly salary to salesmen, $2,400. All right. So the key word here is paid. So how do we pay our salaries? We pay them, obviously, in cash. And what type of an account is cash? Cash is an asset. And so when we pay cash, is it going up or is it going down? Well, cash goes down with a credit. So cash will be credited. And of course, the credit has to be the second line. So we're going to lower cash with a credit. And let's see, how much is it? It's $2,400. I just like to double click here and copy and paste so that I don't mistype the numbers. So now we need a $2,400 debit. So why are we paying these sales or this salesperson? Well, that's part of the cost of a business, which sounds like an expense. So do we have more expense or less expense? Well, obviously our expenses are increasing, so that's why this expense is going to be debited because it's increasing. So let's see what type of expenses we have, and let's use salaries expense. And then we need our explanation, paid monthly salary to salesperson. All right. So now, we received $24.75. So we received $2,475 for 3 months of consulting service. Now here's the key part. To be performed starting in February. So remember, this is January. So this is January. We receive money, but have we performed the service yet? No. So we have not earned this. So this is the key. We've not yet earned this because we've not performed the service. But let's start with the account that's easiest to understand. If we received $24.75, that means we have received cash. So cash obviously is an asset. And do we have more cash, meaning it would be a debit, or do we have less cash? Well, obviously, if we received it, cash is going up. So cash is going to be our debit account. And the amount, double click on $24.75, it's $2,475. Now we need a credit for the same amount. So why did we receive this? We received this money as a prepayment. Now, some of you will think, well, this is a revenue, right? Revenues increase on the credit side, and we would therefore have more revenue, right? No, we've not. We only record revenue if we've performed the service. Here's revenue. Might have gone off the screen. Sorry about that if it did. We only record revenue if we perform the service or we've given them the product. Now, this service we've not performed yet, so we cannot record revenue. We have to record something called unearned revenue, which is a liability. So the key part of this is that we're getting prepaid for something we've not performed. So that is a liability. And how do liabilities increase? They increase with the credit side. And why is this liability increasing? Because we now owe this person that service. That's why liabilities are increasing. And that liability is called unearned revenue. So remember, unearned revenue, this account is used when your customer prepays for something that you've not given them yet. You're going to give them the product or the service in the future, therefore you owe them that product or that service. So you have revenue that is unearned, which is a liability. So we're going to say received cash, received 3 months consulting services in advance. All right, and lastly, the Arkansas, well, you can read the transaction here, or you can read the transaction here. Always double check to make sure that if there's any extra information over here. So the owner, David Henry, withdrew $900. So since cash is the easiest to understand, let's analyze cash. So which way is cash going? Remember, cash is an asset. So does the business have more cash or less? Well, the owner's taking the cash out of the business, so we have less. So that's going to be the credit account. So cash is going down. Now we need a $900 debit. So why did the owner take money out? It's for a withdrawal, which means by definition the owner is taking money out of the business to spend on himself. So these are withdrawals. So does the company have more withdrawals or less withdrawals? It has more withdrawals. So that's why withdrawals are going to be debited. So Henry, comma, withdrawals is the name of the withdrawal account. And then we're just going to say owner withdrawal. Now a more realistic comment in this case in the real world is you'd have the check number there. Because once you know accounting, you can just look at this and say, oh, cash is going down, withdrawals are going up. So obviously the owner withdrew. So in the real world, you wouldn't have to say owner withdrew cash, because you can just look up here and tell that it's that. But we're beginning accountants, so we're trying to keep this simple. And that's it.